and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with July nearing its end, the deadline for filing your income tax return is fast approaching. Income tax return, certainly a tedious process, but a crucial one. So if you have any confusion anywhere, which document, which statement, where to download it from, anything at all, watch today's episode because today my colleague Akar Rastogi will explain all of that in detail. So stay tuned.
First and foremost, you must download Form 26AS and the Annual Information Statement, which is also called as AIS, from the website of Income Tax Department. Form 26AS details the tax that has been deducted against your PAN number. So it details all the TDS that has been deducted against either your salary, from bank or any other source. The Annual Information Statement or the AIS is a slightly detailed version of Form 26AS. So it has details of the income and other financial transactions that the Income Tax Department could trace against your PAN. For example, if you have made any investments in stocks, mutual funds, or if you have received any interest from bank, either it be on fixed deposit or the normal savings bank account, this would reflect in Annual Information Statement. This can be a very useful source to ensure that you don't miss out any income while filing the income tax return. So just go to the website of Income Tax Department, log into your account, and over there in the menu, you'll find a tab by the name of E-File. Click on it. There would be a sub-menu and you'll find income tax returns over there. Just click on it and you'll get Form 26AS. Likewise, under the Services tab, you would find Annual Information Statement. So just download both of them beforehand. Ensure that you have Form 16 against all the taxes that has been deducted against your income. The next document to arrange would be a consolidated capital gains statement. So if you have made any investments during the previous year in mutual funds, whether it be an equity fund or a non-equity fund, or have invested in stocks, you are likely to have capital gains, specifically if you have made any redemptions or made any sale transactions. While it can be quite tricky to calculate capital gains, it is not required to do it manually. You get a consolidated statement from the fund house or even the stockbroker. You can go to the fund house separately and request them an annual consolidated capital gains statement. It can be generated from their website itself and the statement is sent within minutes. Even better, if you go to the mutual fund registrars, which is CAMS or KFinTech, Carvi as we say, you can get the consolidated statement across the funds serviced by them. Just go to their website and you will definitely find a tab by the name of Investor Services or Mailback Services. There would be an option by the name of Capital Gain Statement. It will ask you to enter your PAN and the email address that is registered with the fund houses. Just enter that and the capital gain statement would be sent to your registered mail ID within minutes. The next document that you should arrange should be an interest certificate, or if we say in simple words, it should be the details of the interest that you have earned from your bank. So one, you might have some fixed deposits with a bank, or you must be at least carrying a savings bank account. Banks do pay you interest on the balance maintained in the savings account as well. You don't have to go transaction by transaction. Just log into your internet banking, go to the tax center, and you will definitely find a tab by the name of My Interest Certificate. Just download it from over there. It's a simple consolidated statement with the transaction date where the bank mentions the amount of interest it has paid to you during the financial year. The other related document would be the interest certificate related to your home loan. If you have a home loan, just ask your lender to provide an interest certificate for the whole year. So when we file an income tax return or when we claim deductions, the interest paid on your home loan during the financial year is applicable as a deduction under section 24B, and likewise the amount of principal that you have repaid is eligible for deduction under the famous section 80C. Another document would be Form 16. Well, most of you would be already familiar with it. It's a statement that we get from our employer just a few months after the financial year ends, say somewhere around May or June. So it has all the details related to your salary income and the TDS deducted by the employer. Likewise, you would get a similar form 16, it would be 16A from your bank if they have deducted interest from your income. If the interest income paid by the bank is more than 40,000 rupees in a financial year, they are likely to deduct TDS. Do ensure that if your bank has deducted TDS, that you get a similar form from them. A few other statements to keep handy before you start filing your income tax return so that the process is done smoothly would be a consolidated statement of your ELSS investments. Yes, we can get a single statement if you're investing across 3 or 4 or like say any number of tax saving funds. To get the tax benefit under section 80C, you can simply log into the mutual fund registrar's website, CAMS or CARVI, and they provide a consolidated statement where they simply give the investment made by you across tax saving funds specifically during the financial year selected by you. This can help you input the value while claiming deduction under section 80C of the Income Tax Act. Likewise, it is quite possible that you might have made investments in National Pension System or the NPS Tier 1. So if your employer is also investing or contributing to your NPS account, there's a chance that the same would be reflecting in your Form 16. But even if he is not and you are just making voluntary contributions from your side, then you can go to the website of NPS or the eNPS if you have an account through NSDL, and you can download the holding statement and the transaction statement for the relevant financial year. The investments made in NPS can again be claimed as a deduction. Likewise, there are 2 more documents that you should keep handy. One is receipts of any donation that you might have made during the financial year and are eligible for deduction under section 80G. Second is the bank details. Just keep your checkbook. No, you don't have to use it to pay the taxes. You might be, but the main thing is that when you start filing your income tax return, it is always recommended that you first provide details of your bank accounts. The income tax website says that you must provide details of all your bank accounts that you held during the previous year. So you would need to provide the IFSC number, the account number, and all such details. Well, it is very important to choose the right ITR form while filing your income tax return. The Income Tax Department has segregated income earners into several categories and accordingly allocated different forms for them. For example, if you are a salaried, there is a different form. If you are running your business or into a profession, there is a different form. If your income is up to rupees 50 lakh in a year, there is a different form. And if it is more than that, there is a different form. The 2 to 3 major forms that are mostly used are ITR 1, 2 and 3. So ITR 1 belongs to you if you are a salaried person and have just one house property, not more than that. And further, your income in a year should not exceed 50 lakh rupees. Then you can opt for ITR 1. It's a very simple form and won't take much time. But let's say, like in most cases, if you have invested in mutual funds and stocks and have made any sale transaction or a redemption transaction, that is to say, if you have realized capital gains during the previous financial year, then you'll have to fill form ITR 2, provided you are a salaried. And if you are a person who runs their own business or into a profession, then the ITR 3 would be applicable to you. But there's no need to worry. When you start filing your return, the Income Tax Department, the portal itself over there gives you an option to choose the right ITR form. First, you just have to fill in the relevant assessment year, and then you'll find a tab by the name of Help Me Choose the Right ITR Form. Just click on it and it will give you a list of all the forms along with bullet points for you to read and understand which one is applicable to whom. Just select the appropriate form from there. Well, the new income tax portal has made it very convenient to file your income tax return. One, you just have to select the appropriate form and then it throws a number of schedules for you. These schedules are nothing but a specific form related to specific income. Say for example, there would be a capital gains schedule if you have income related to capital gains. Likewise, if you are salaried, there would be a specific schedule by the name of income from salary. So first, just select, there would be check boxes against each schedule. and you have to just select what all schedules are applicable to you. Just go through them thoughtfully and just select the ones that are applicable to you. Once you select the relevant schedules, the income tax website would pre-fill most of the information that it already has basis your Form 26AS and the annual information statement. Thereafter, you don't have to do much. Just go through all the schedules one by one, verify the information that it has pre-filled on your behalf, and make any changes wherever necessary. Here, it is very important to ensure that although Income Tax Department pre-fills the information basis of Form 26AS and Annual Information Statement, there is no guarantee that it would be correct. So match it with the original numbers that you have with you in your form, in the initial documents that we arranged. That would be Form 16, the capital gain statement, and likewise. As soon as you confirm the schedules, a green tick mark will appear along with each schedule. Once you have verified all the schedules and made necessary changes wherever required, just submit your return, preview it. There would be an option to preview it. The last step would be to e-verify it. That is very important. Unless you have e-verified your return, it won't be processed by the Income Tax Department. While there are a number of ways to e-verify your return, the simplest one is to e-verify it using the OTP sent to your registered mobile number, which is also linked with your Aadhaar. Just click on that option and an OTP will be sent to your mobile number. Fill that OTP and your return would be verified. If you're seeking more details on how to file your ITR 2, wherein you have realized capital gains during the previous financial year, you can refer to one of our stories with the heading How to File Your ITR 2. It's a step-by-step guide that will help you file your income tax return. So first of all, it is important to understand that only if your gross total income, that is the annual income without any deductions, is exceeding the basic threshold, which is 2.5 lakh rupees. If your age is less than 60 years, only then you are required to file your tax return. If you are a senior citizen, it is 3 lakh rupees. All the individuals must file the income tax return on or before 31st July of 2022 for the previous year, that is 1st April 2021 to 31st March 2022. However, if you are unable to file your return on or before 31st of July, the Income Tax Department penalizes you in 3 different ways. Number 1, you will be liable to a late filing fee. The late filing fee is further segregated into 3 parts. 1. If you manage to file your return on or before 31st of December 2022, the late filing fee would be 5,000 rupees. And if you file your return after 31st of December, then it would increase to 10,000 rupees. However, if somehow your total income does not exceed 5 lakh rupees in a year, then the late filing fee penalty has been restricted to 1,000 rupees only. The second penalty that is applicable is in the form of interest. Whatever tax liability you have, an additional interest of 1% per month on that amount is applicable till the time you file your return. The third way in which it penalizes is that it doesn't allow you to carry forward the unadjusted losses. For example, there is a possibility that you might have realized capital losses, say on selling mutual funds or equity stocks or through any other capital asset. The Income Tax Department allows you to carry forward the unadjusted losses for 8 consecutive years. But if you fail to file your return on or before the due date of 31st July, then you are not allowed to carry forward these losses into subsequent years and adjust them against the income of those subsequent years.
Well, with that, it's a wrap. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thank you for watching. Bye for now.